Well, welcome everyone to the monthly market update from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor, joined once again by Bob Paolucci, our founder and CEO. Bob, welcome back. Happy spring.
Hello, Julina. Hopefully, summer is arriving soon.
Yeah, so far so good. And we do these updates every month, but we have a lot to talk about even from the previous month. And there are a few things that we wanted to address today. The first being we have talked a lot about the three hurdles that we need to overcome for the stock market to enter its bull market, which are the Federal Reserve, earnings, debt ceiling. We have updates on all three of those today. We want to talk about the possibility that the bond and stock market might have entered their bottoming in October of last year. And then finally, top of mind with clients around the banking crisis and recessions. We're gonna spend some time there.
Yeah,
How's that?
absolutely. Yeah, that sounds great. Hey, we have slides for all this stuff. So,
Love it.
the Federal Reserve, it sounds like they pivoted. We'll get into that. They changed their language. You now have the market starting to price in rate cuts. We'll talk about that. Earnings, yeah, I think ultimately over time, right, corporate earnings will really decide and dictate the path of the stock market, which, over long periods of time is much higher compounded. We'll give you an update there. The debt ceiling, which is political theater, they seem to be negotiating as we speak. They're talking, which is a good thing. Um, so again, we think that will be a non-issue. Could create a little bit of market volatility, but ultimately we don't think there'll be a default. We've talked about this multiple times now, but we'll give you an update. And then we'll have some fun. And that's 4, 5, and 6 on this list. So let's get right into it. The issue we have in the markets and the economy spawned from higher interest rates, which spawns from spending and creating more money in history over the past few years, mostly due to the pandemic. But now we have to pay the price for handing out and creating all this money, right? So we had inflation, and with inflation and wild economic growth, we have the ability to take rates from the emergency level of 0 to something higher. The Fed themselves did not expect to go this high. We know that because we read their quarterly outlook that they put together. And it just seems every quarter they kept revising their outlook. We're gonna bring rates to 3.5%, and then we're gonna bring rates to 4.5%. And we think we might have to bring rates to 5%, was their last outlook about 6 months ago. So,
And
well,
here we
we're
are.
we're here. We're at 5% interest rates, and that has led to a scenario where the current rate of interest or overnight interest rates is at about 5%, which is where their dot plots, these dots on the screen, are listed. They've met their objective, quote unquote. And you have this blue line, which reflects the bond market saying, great, congratulations. Now we think you're going to have to move rates down by more than you think, sooner than you think. And I believe the bond market is right. And I believe the Fed will actually have to consider, talk about, and potentially cut interest rates before the end of the year.
And
If the Fed had it their way, Julina, they would just follow the dot plot, which is, in all fairness, if you look at this chart closely, the Fed expects to cut rates by about 1 full percentage point from 5 to 4 by the end of 2024.
right.
The
And
bond market is saying you're going to have to do that a lot sooner.
and this isn't unusual. Historically, they begin to cut rates within a year after they have finished raising them.
That is correct. Historically, when they go from pivoting, from increasing to neutral to
Mhm.
flat, in essence, it's for a reason, and that reason is they've seen the impact of a slowing economy, of tightening credit, of higher interest rates, and nobody wanting to refinance in a much higher interest rate environment. So that slows economic activity, and then to create some economic activity, they they cut interest rates. They
Right.
make borrowing more affordable. That makes sense.
Absolutely.
We have in the top right hand corner the subtle language change from their prepared statement at their meeting 2 weeks ago, which even Jerome Powell said, don't ask me if we're pausing or pivoting, just read the language. In essence, he's saying, I don't want to verbalize it in front of the media because I think everyone will celebrate and the market will start to rise in anticipation of us cutting rates. So I'm just going to refer you back to the prepared statement. And here is what he was talking about. The red line is what they removed, saying that they anticipate some additional firming, which is more interest rate increases. Two, a change in determining the extent of which additional policy firming may be appropriate. May be appropriate. Okay. As the Fed is considering cumulative tightening of monetary policy. Oh, Lord help us. What does he mean? What he means is that there's going to be an impact um, to liquidity, to borrowing and lending from the banking stress that they created. And he, in essence, is saying that is going to have a rate increasing impact because credit won't be available. And if it is, it'll be slowly available. And that will also help slow the economy. So they're going to look at we have high interest rates, and now we have banks that aren't willing to lend
Mhm.
as much or as quickly. And that is going to have the same effect as if the Fed were to increase interest rates by another full point, which is something they don't want to do.
Of course. Yep.
So the lack of oversight of the banks that's really in the Fed's hands has created something else, an X factor that will do their dirty work for them. Does that make sense? And they're well aware of
Of course. Yeah.
it. Okay,
And we have a couple slides towards the end that are going to talk a little bit about that too.
sure.
Yep.
So here we are with the Fed. Um, if you read the language, there's a pivot in the language, and the expectation is for a pause going forward until we have cuts. We think cuts again will come probably later this year.
Okay.
Well, excuse me. Corporate earnings. So corporate earnings have been okay. They haven't been awful, and the expectation for 2024 is about 10% higher. So, historically, you have earnings growth of really on the chart on the top right hand side, you have historical earnings growth of about 8.4%. And if you take that 8.4% and you look at the S&P 500 price growth or total return growth over that same period of time, it's almost identical. There are periods, 6-month, 12-month, 18-month periods where the path of the stock market and the path of earnings will detach. But Julina, we've talked about this many times. We have found that if you measure over 3-year increments, those trends tend to be tied very closely to one another. Does that make sense?
Absolutely.
Yeah. So the market will go in the direction of earnings.
Mhm. Yeah.
And if the direction of earnings looking out on the horizon beyond the trees is much higher, then markets should be moving much higher. Everyone wants to know when, and I would say soon. So it's coming. Um, and we'll get into that a little bit more. So we have probably 2/3 um, soon to be about 75% of the S&P 500 companies reporting earnings for Q1.
Mhm.
And so far, so good. We've had over 80% of the S&P companies reporting either a match or a above expectation beat on their earnings. That's a very high percentage.
Amazing. Yeah.
Don't fall in love with that though, Julina, because part of that is Wall Street analysts lowering their expectations.
Sure.
So this is, did you beat Wall Street's expectations with your earnings release?
Yeah.
So, you know, I guess if you ask the company what their expectations are, that's probably a better measurement. It's not tracked. it's really versus Wall Street expectations. But still, this is very good. So the direction of earnings is quite good, better than expected. It's really hanging in there where the expectation from a lot of these negative investment banks has been earnings are going to fall apart. They really haven't. So,
Right.
which is why we have a market that's hanging in there.
Yeah.
The debt ceiling. Oh boy. So, um, any negotiation is tough. And then you have Washington. Every negotiation is tough, right? Every negotiation sounds impossible, and then somehow something happens. We like to get very granular and look at the logistics of how this stuff can happen.
Mhm.
And ultimately, with any negotiation, you need you need everyone's schedule to free up. You
Right.
need to be able to come together. And this is a cute illustration showing in the month of May, there are only 7 days where Biden, the House and Senate are able to get together to vote on something.
Mhm.
So today being the 16th, you can see on this calendar, the green zone it ends tomorrow, Wednesday the 17th. So if a deal doesn't get done today or tomorrow, and if you're listening to this video, it's probably going to be the 18th or 19th. Um, then it gets pushed into June, unless Biden doesn't visit, wherever he's supposed to go, and um, and the House comes back on Friday the 19th. So you can see just from scheduling alone, you have to be available to actually pass something, vote on something, and get it through the various channels. So let's hope that everyone cancels their vacation plans um, and they really stick together, hold hands, and get something done. We think
Yeah.
it's highly likely that if it's not done in May, it'll certainly be done early June. That makes sense?
It does. And I think it's always an important reminder, right? One of the reasons that everyone thinks it's so likely is that we have raised it over 100 times. And so this really isn't a question of if, it's more when. And the when is the very frustrating part for us.
Yeah, we've never not had a deal.
Yeah,
The U.S. government has never defaulted, and we don't believe it will ever will. But because of the way this is designed, it creates a scenario where the parties can throw punches at each other,
sure.
and it'll be that way and until it's not that way. So one thing to point out is, this is 2023 spending and estimated income. And you can see this is the federal budget. So on the left-hand side, you have what we spend money on. So we spend $6.2 trillion, but we only bring in about $4.8 trillion, right?
Right.
So if this were the world of personal finances or our clients' finances, we would say, Houston, we have a problem. But it's government. So we could just print money and borrow. So long story short, you could see that income on the sources of financing, income tax, that is about $2.5 trillion. It's 41% of our financing. Corporate tax, 475 billion, and then self-employment tax, the payment towards social insurance programs, is 1.5 trillion. However, on the left-hand side, you see that Medicare and Medicaid alone is just about a $1.6 trillion expense, which has come way up over the past, you know,
Sure.
3 years, 5 years, 7 years. Social Security, um, if you're listening and you received a 10% cost of living increase, followed by an 8% cost of living increase, followed by what's probably going to be another 5% cost of living increase, that has helped the Social Security expense balloon up to about $1.4 trillion. So between Social Security and Medicare, Medicaid, that is about a $3 trillion expense.
Unbelievable.
So that means that expense exceeds every dime of income tax that we collect in this country. Those two expenses alone. So at some point, I think our politicians have to have a very common sense conversation about um, maybe adjusting retirement ages,
Mhm.
um, maybe some type of reform on some of these programs that are going to become unaffordable, regardless of the party in power. You can tax people 80%, and we still won't be able to pay our bills. So there
Yes.
has to be some type of um, conversation, at least, around um, coming up with a plan to extend the life and health of these programs.
And I guess the other observation I would make when I look at this is when is the next debt ceiling debate after this one, right? Given the gap between the left and the right. This is
Absolutely.
going to continue.
Absolutely.
Yeah.
Yep.
Okay.
Um, the market bottomed, we think, mid-October. So we think the bull market started in mid-October, and it'll officially be called when the S&P 500 closes 20% above its mid-October low. Does that make sense?
It does. And just to clarify, we're not suggesting that it remains in a straight line for the rest of the year.
Absolutely.
Yeah.
It'll always be choppy.
Yep.
However, we think the lows of the market are in,
Mhm.
and at some point this year, you will hear in the financial media that we're in a bull market. Um, I'm happy to say that we've been invested in a bull market, right? Because it's one thing to say, hey, a bull market's here. But hopefully you've been invested in it, because that means the market went up 20% from its low. And if you're listening, you are invested in the market and you're receiving some of the appreciation since the mid-October low. So more to come on that, but we just want to show you why we're saying the bull market is on the horizon. Um, the bond bull market is here. And this is just an inverse chart, right? People look at price. This is yield. So yields have dropped by about 15, 16% since the October low. What does that mean? That means yields peaked out in October and have come down, which also means bond prices have gone up. That makes sense?
It does. And just to clarify, because the Fed did just raise rates a couple of weeks ago. This is a great example of the market anticipating their moves going forward.
Exactly. Yeah. When in doubt, trust the bond market.
Yeah.
And the bond market is saying, okay, Fed, you can increase all you want, but you're soon going to have to cut interest rates because of what we think you're doing to the economy.
Sure.
So, um, one of my favorite charts, we're probably going to have everyone watching this fall asleep within the next 10 seconds. But ultimately, stocks and bonds compete for your money as an investor. And the lower yields are, the more you should be invested in stocks, right? If a bond offers you 2% for 10 years, you probably want to put your money in the stock market in a diversified basket of securities that will very likely outgrow the 2% that you're receiving from the safe investment.
Sure.
But on the flip side, if bonds, if investment grade or government bonds pay you 9 or 10%, then I would argue and say that they're really competing with stocks for your money. If you can get 6, 7, 8, 9, 10% risk free or with minimal risk, who cares about stocks? Today, we have some balance for the first time in a long time, 17 years. We have pretty good interest rates, somewhere between 4 and 5.5% interest rates that allow us to get good income for our investors and provide diversification, a hedge to stock volatility. When interest rates are low, you don't have that hedge because the risk is interest rates will rise and bond prices will fall. So you have to take more risk than you want to take. You invest in the stock market. Today we have good balance. However, Julina, based on that conversation, if interest rates start going down,
Mm-hmm.
if what I said is true, then stocks start going up.
Right.
Would
Exactly.
you agree?
I do. And I think one of the interesting things about this slide, because it does look confusing, is that it's important to know that the value of the stock market can't be taken in a silo. It has to be compared to the bond market. And there is a correlation of the two, and there's a relationship that we need to consider.
Absolutely. Yep. So just basic rule of thumb, as you see interest rates decreasing, there's in essence less reward for you and less safety as an investor in bonds. Um, so you might want to look to the stock market. As you see interest rates increasing, there's more reward for you while taking less risk. So you might want to look more at bonds, less at stocks in that environment. Well, we just talked for about 20 minutes about an environment where it's very likely rates are coming down, which
Sure.
means stocks should be
You can
going up.
justify the price of stocks going higher.
Yeah, so that's a real basic explanation, but I think if you can remember that as an investor, um, that is they're highly synced over time.
Yeah.
It's a good rule of thumb to think about, and I thought it was worth putting that chart in here for everybody. Bank deposits. Everyone's
Yeah.
been talking about, listening to, hearing about bank risk, bank deposits. So you can see over the past, let's call it a year and a half, this is a measurement of deposits at all banks, that it's been downward arcing really since the end of last year, certainly the beginning of this year. Why? Well, at banks, depositors are getting 0.25%, maybe 0.5% if you're lucky, on average, 0.1%. In an environment where government money markets and short-term treasury bills are paying 3.5, 4.5, in some cases 5%. So the Fed, by increasing interest rates, has provided some competition for depositor money. Why have excess cash sitting in a bank account when you can invest in treasuries at 4 or 5%?
Right.
And what has that led to? It has led to this chart: less deposits available at banks. Well, what does that mean? Well, that means that banks, in order to continue lending, they need help.
Yeah.
Not all banks. So the Fed last month created a loan program where they could borrow money from the Fed in exchange for handing back their government securities that banks put your deposits into. That makes sense?
Yeah.
Um, the reason why there has been a need for this is um, when banks take your deposit, they buy government securities, whether they're short term or long term. They make that decision. On average, the banks will split your deposit half into long term government bonds, half into short term government bonds, right?
Sure.
Why short term? Well, short term, in the event you deposit $500,000 and you need 250 back in a week, they want to make sure they plan for that. But the long term securities, because interest rates went up so far so fast, that has brought the value of those bonds down slightly to the tune of maybe 10%.
Mhm.
But if you're a bank and you have $300 million sitting in long term bonds, 10% is $30 million. You potentially might have a $30 million shortfall.
Sure.
Not good if you're a bank, right? Because your savior is the FDIC. But if you call them, that means you are no longer solvent.
Correct.
So the Fed quickly woke up, and the Treasury woke up to say, look, okay, hand us back your government bonds that are at a discount to par value, and we will let you borrow full value against them. So hence, we talked about banks slowing their lending because they don't know how much they have on deposit. They don't know if it's safe.
Yeah.
Um, um, and hence all the headlines around banks and what's going on with banks, bank stress, so on and so forth. So it just
Sure.
shows you that it looks like the flight risk of bank deposits has flattened out on the far right hand side.
Yeah.
And it's not so downward arcing like it has been over the past 3 months or so.
Good news.
And here you go. Less sticky deposits means tighter lending. So if banks don't know how much they're going to have on deposit, they really don't know how much they can lend out. And again, the Fed has addressed this through their language, through creating this program, and through their forward-looking statements of we might have to stop increasing interest rates. So
Yeah.
here we are.
Here we are.
Julina, inflation continues to cool.
You
Uh,
know, I can't wait for you to talk about this one because
I'm I'm
everyone still
so
doubts this.
excited. Absolutely. So you understand that that blue arrow is pointing down, right?
Oh
Okay.
yeah.
I'm just asking for a friend.
Okay.
So you have inflation, CPI, registering a 4.9 level, which is the lowest in over a year, 2 years almost. Um, but another fact, the June 2023 inflation report, which is the May release of inflation, will give us 12 consecutive months of declining inflation for the first time ever in history. How about that? So anyone that acts like inflation is on the rise or
Right.
inflation is still red hot hasn't been paying attention to us or just hasn't been paying attention in general.
Now, Bob, are we saying this with such confidence because the May and June inflation data for 2022 that's about to roll off was so extremely high? In fact, I think it was the highest numbers we've seen.
Absolutely.
Okay.
Um, Here's a scenario where we actually know the future. And what we can tell you is the next 2 months of inflation data, the months that are rolling off for the new months to roll on, are two of the highest in history. So we are quite confident at
Yeah.
Principal Wealth Partners that inflation, the overall CPI number, as the months roll on over the
Right.
next 2 months in particular,
Right.
um, there's a chance that we are in the low threes for inflation by July.
This is not a crystal ball on your desk somewhere.
We could go with that,
Yeah.
but I would say it's us paying attention to the monthly numbers and understanding how the inflation data works.
And that data, if you can repeat it, gives us a 3 in July.
Somewhere in the threes.
Yeah.
It all depends on what rolls on.
Amazing.
But yes, I believe in the inflation number will start with a three, which is what we have been saying here at Principal Wealth Partners, Julina, for just about a year.
Sure. And
So
another reason we're confident the Fed is done.
correct.
Yep.
Yep.
Just wanted to hear it again.
Absolutely. Will we have a recession? Are we in a recession? Did we have a recession? Is probably the better question.
Yeah.
Um, I would say it this way: if you glue together weakness in the economic data that has been seen here and there over the past 5 quarters, over the past 5 quarters, we have what looks to be a recession if you measure it diagonally.
Hmm?
So the weakness that we had in the GDP data, the economic growth, the um, very accurate
Sure.
2 consecutive quarters of negative GDP growth, which usually defines a recession. We actually had that in Q1 and Q2 of 2022. We check that box, which it's a huge box to check. However, nobody really talked about a recession. Why? Well, there were a few outliers, and those outliers were um, consumer spending, which wasn't awful Q1 and
Sure.
Q2 of last year. It wasn't awful because it was coming off of a very awful period, the pandemic. So it was starting to ramp up. Number one. Number two, employment.
Hmm.
And kind of the same theory there. We were coming off of a massive amount of unemployment. So the unemployment level was dipping.
Yeah.
So I don't know. I would say the Q1 and Q2 period of last year to me looked like a recession.
Okay.
It
And
wasn't labeled, it wasn't called, or it hasn't been called yet. There's still time
right.
for various reasons that we talked about, and maybe some political reasons as well. So, when you have midterm and presidential election years, sometimes uh, sometimes weird things happen. I'll
Yeah.
leave it at that.
And
So,
can I also I would also argue like red on this chart means recessionary. Green means good. And you can see clearly on the left-hand side of the page the recession of the pandemic of 2020. And then you to what you brought up about at the end of 2022, you can see the red showing up a little bit more on the page. And as you move towards the right, you start to see it disappear a little bit. So I agree. And I also would say, does it really matter at this point if we're in a recession or not? Because I think that we're either slightly in one or we're slightly out of one.
you're right, Julina. You know what it is? It's closure,
Yeah,
right? It's will we have that bookend
sure.
to finally close the cycle,
Yeah,
right? Will we get closure, or will we not land and the plane just keeps flying and we enter the next bull market and the next economic expansion?
yeah,
So, yeah, I think at the end of the day, the fact that you're hearing about it on TV all the time, you're hearing us talk about it, it's the most widely talked about recession that we haven't had yet, even though we're still talking about a recession.
yeah.
So, how bad can that be if we see it coming? Number one. Number two, well, if we have a recession, then that means that an economic expansion and bull markets are right after it, or they usually start while it's happening.
Exactly.
And we might have that right now,
Sure.
you know.
I agree.
So if you look at, there's a chart that we didn't put in this slide, but there's a chart of all the big Wall Street firms, the big firms, and I call it the table of disagreement because I've never seen this level of disagreement around economic slowdowns, recession, so on and so forth. These firms are all over the place.
Yeah,
You have some in the camp of we have a recession right now, you just don't know it yet, to we're clearly not going to have one, and here's why. And there are valid points that these firms are making, but none of them know the future. These are all
sure.
based on current expectations and trying to project forward. I would say this. I would say high interest rates that stay in the system for a long enough period of time will certainly slow the economy. Um, the fact that we have many baby boomers retiring, it is creating this unique, for every experienced, tenured baby boomer that knows how to do many things, you have to hire two millennials or three millennials to replace the one boomer that's retiring. So my view of employment is skewed. I just don't think that the workforce is as productive. I'm saying this because the government measures productivity and it has not gone up, it has gone down,
It has, yeah.
which means there's a lot of money being spent to replicate the
What's been
impact of
done.
a working baby boomer.
Sure.
Um, and it's very inefficient. That makes sense?
It does, and it's something that we've looked at for years that hasn't changed.
Correct. So I don't know that I really trust the unemployment number. I would say we're somewhere in the middle with a recession. It could happen. We can see it playing out,
Yeah,
but then we can quickly see the economy finding its footing pretty quickly because you now have a Fed who is paying more attention to it than it has over the past 6 months.
sure.
Yeah.
Okay.
So, um, and here's to back up what we were saying, recessions create unemployment, but we have employment, right? We actually have the unemployment level,
Right.
at a 60, 70-year low. And it's hard to say that we have a recession when there are 1.7 help wanted ads for every unemployed individual, right? So ultimately, in this environment, if you are employable and you want to work, you can easily find a job today.
Yeah.
You might have to drive a little bit more than you're used to. You might have to move, but you can find a job. Whereas in typical recessions, Julina, you will all know a lot of people that are unemployed, looking for jobs and not finding them. That is not the case today.
Yeah. And just to clarify this page a little bit, if you're looking at it for the first time, because I've had this conversation over and over again over the last few weeks, and there's a lot of doubt when you bring up this conversation, but you see the spike in unemployment, which is the blue line, and you see the correlation to the gray shade, which is a recession. And you go all the way back to 1950, and there is such a heavy correlation of the two. We just don't see it right now.
Yeah, if you're hearing about mass layoffs, every industry, your neighbors, your friends, your family, your kids, your parents, um, and you don't hear recession, wait a month, right? Because they're so highly connected. And that's why we put this chart here to say, look, one of the hallmarks of a recession is there are no jobs available. There's a lot of layoffs. There's a lot of bankruptcies, failures. Um, there's a lot of bad stuff going on
Right.
financially. And this go round, we don't have that.
Sure.
You could say yet. Okay, we'll go with that. Um, but one of the indicators for us would be, but there are so many help wanted ads. When we see them get cut in half, when there's one help wanted ad for every one unemployed individual, then we have a different situation. But
Yeah.
right now it's 1.7 help wanted ads for every one unemployed individual. So we're just not there yet, and we don't see this ticking up meaningfully. We can go from 3.5% unemployment to 4, but I think to get a recession, we really need to get closer to 5.
Right. Well, and I think an interesting example of just this past weekend over Mother's Day, when I talked to a lot of moms about whether or not they went out to dinner or to lunch, and a lot of them responded, well, there's no restaurants to go to that have good service right now. There you
Absolutely.
go.
Yeah, we were supposed to go to the Madison Beach Hotel. They have a big restaurant there in Madison, Connecticut. And I heard people with reservations were waiting 45 minutes. People without reservations were, best efforts. If you stick around for 2 hours, sit on the beach, maybe we can seat you. So, and that's everywhere. We're hearing these stories everywhere.
We are,
Um,
yes.
if you've been to an airport, if anyone's done any traveling, if you're listening, airports are very busy. If anyone has been on Route 95, yeah, traffic is back.
Sure.
It feels like traffic is back times two.
Yeah,
That's how bad it is. So there's economic activity. So those are
exactly.
the slides. Again, our view is we're getting closer to a bull market. A lot of the work has been done. We're happy we are invested the way we're invested. We're taking advantage of the opportunity in the bond market and in the stock market. We do think that the rest of this year, maybe after the next 3 months, will look pretty good. 2024 is shaping up to be an exceptional year. More to come on that. And we are excited. So hopefully, Julina, we're keeping everyone informed.
I certainly hope so. We put a lot of thought into this, as our whole team does, and I'm looking forward to the June update. I think we're going to have a lot more to talk about on these same topics, but they continue to be at the forefront of the media and are on top of mind.
Absolutely.
So thank you, Bob, again for all of the insight. And I will end as I always do. We are here for you. If you have any questions, please reach out to any of us, and we appreciate the trust.
Yeah. Thank you.